Hey, it's Thursday, June 1st, and it is 2 o'clock. What does that mean? It means it's time for Mortgage Minute with Art Alvarez. Hey, before we get going, I just want to ask you a question. If you had ghosts in your house, who would you call? That's right, you'd call the Ghostbusters. But if you want to get equity out of your house or close your deal, who are you going to call? You need to call Art Alvarez with Mortgage Works, and he is our expert. And let's face it, when you want to call an expert or you want somebody to help you, you want an expert. And well, when it comes to mortgages or refinancing or strategies, he is truly the MacGyver of what he does. He's been doing it for over 4 decades. If you need something worked through and fixed up and he's going to prove it today, this is your guy. So let's bring him on. This is MacGyver. This is Art Alvarez. Art Alvarez, welcome.
Thanks, Jeff. I didn't realize that my middle name was MacGyver, but I'll keep that in mind.
Yeah, that's right. Well, I was going to go with Mr. Gadget, and I thought, that's too many pieces of tools. But MacGyver, he can fix anything. And
especially with my
the
slide
more I'm
rule.
around you, I realize exactly. Yeah, the more I'm around you, the more I realize that there's almost nothing when it comes to financing, refinancing, getting mortgages done that you cannot do. And I'm excited about today's show because let's face it, there is a powder keg with a very short fuse going on right now, and I won't blow the deal, but I'll have you talk about that today.
Okay, sounds great.
Hey, before we go, I just want to remind everybody this is a live show and I'm manning the comment section. So if you have a question about what Art is talking about, or if you have a specific question on your situation, please put it in the comments, whether you're on Facebook or you're on YouTube. We're happy to have you. Put it on there. I'll put it on the screen and Art will jump on there. If for some reason you're joining us after the show and you're watching this and it triggers a thought, hey, I have a question for Art, put it in the comments and he'll get to it. With that, I'm bowing out. Art, this is your show.
Thank you very much, Jeff. Welcome, everyone, to this week's Mortgage Minute. I'd like to go right into it. It's been an interesting week, especially as it regards interest rates. So, of course, as we usually do, I want to start with just an update to all of you as to where we're at with mortgage rates. And as you know, I always suggest go to our website. Right there on the homepage, we have our interest rate grid where it gives you indications of where rates are right now. And, of course, don't forget at the bottom of that grid is a tab for about mortgage rates where I go into more detail about how mortgage rates are determined from day to day. And when you look at this grid this week, it's a little bit of improvement. We're crawling almost back into the fives. When you look at this grid, for example, FHA, for example, is getting back into the 5 range and so forth. Now, what is going on? Why have rates improved this week? As you may recall, when you look at the 10-year bond chart, which Jeff will pull up here in a minute, last week it was looking not so good. The 10-year bond yield had gotten up into the 380s. In fact, end of last week, right before the holiday weekend, it got up to as high as 3.85. So that was definitely not a good trend. And at the time, I had suggested to everyone that I thought most of that increase in yield was probably due to the jitters associated with the debt ceiling talks. And I did make a prediction that if we can make some progress on that should calm the markets and we should see bond yields dropping. So what exactly did go on here this week that caused this change, this downward trend that we like to see? Well, of course, it was the fact that the the debt ceiling talks, actually during the holiday weekend, there was a news story that they had reached agreement in principle. But of course, that was still subject to votes, both by the House of Representatives and by the Senate. But in the meantime, just the fact that there was an announcement of an agreement in principle was enough to kind of calm the bond market as we opened up this week on Tuesday. And of course, Monday was a holiday. So as a consequence, that's when we started to see this improving trend. And it was interesting because there was a little bit of a divergent reaction in the markets. The stock market has actually been kind of down all week up until today, actually. Whereas, so the Dow Jones Industrial Average was lower most of this week. The 10-year bond yield dropped. That's a good thing. Now, remember, when you're talking about bonds, there's an inverse relationship between yield and price. So a lower yield means a higher price on the bond. So in that respect, it was a sort of a divergent reaction. Stock prices down, but bond prices up, which bond prices up is a good thing because that drops the yield. So what else was causing this improvement beyond the fact that we made progress on the debt ceiling talks? Well, the other thing that came up actually a couple of days ago was euro inflation. The inflation rate in the European markets had gone lower. So I think that was also a kind of a secondary effect that helped with our bond yields this week. And the other thing that came out this week was comments by two Fed officials, one a Fed president and the other a Fed governor, both who had suggested that the Fed might actually pause, or as they like to describe it, skip another Fed funds increase at the June meeting, which comes up in a couple of weeks. Now, what does skip mean? Well, what they're trying to say there is not necessarily that the Fed is going to stop with raising the Fed funds rate, but there's a growing sentiment that maybe they'll just skip doing anything in the June meeting, look at more data, and then reconsider any further increases after the June meeting. So that's what's being suggested now, which I think is also a contributory factor in getting our bond yields lower. And in fact, even a pretty well-known guy, Jamie Dimon, some of you may have heard of him. He's the CEO of Chase Bank. He even chimed in to suggest that the Fed may want to pause or skip doing anything in June to again reassess data and then see where we go from there. So all this is good news. The trend is back in the right direction. In fact, right now, as we're doing this show, the 10-year bond yield now has dropped just below 3.6, about 3.59. So a little bit more improvement, and we'll see how that plays out for the balance of the week and going into next week. But I think the trend is now back in the right direction. So with that, that's your update on current level of mortgage rates and bond yields. Now, the next thing I want to talk about, and this came up in the news earlier this week, Rocket Mortgage, which is, I believe, the second largest wholesale lender in the country, did a news release where they announced their conventional 1% down program, which, of course, that was big news and got a lot of attention. But it's an interesting announcement because it's actually not a new program. One of the lenders I do business with, called UWM, or United Wholesale Mortgage, which is considered the largest wholesale lender in the country, already had this program announced a few months ago. So what is it about the Rocket announcement that's noteworthy? Well, first of all, just for the basics of the program, the 1% down payment program, how do you get to just a 1% down? Well, the program features a 2% grant that's made from the lender to the borrower toward a 3% down payment. So that's where you get the 1% down. You're putting 3% down total, and borrower puts 1% down, and then the lender provides a 2% grant to get you to your total of a 3% down payment. But a little bit of a catch to that. The 2% grant is 2% of the purchase price up to a maximum of $4,000. So think about it. If you're talking about a $4,000 max for the 2% grant, well, you can kind of backwards calculate what does that mean in terms of purchase price. Well, to be a true 1% down when added to a 2% grant, where the grant is only a maximum of $4,000, then that essentially means the maximum purchase price is going to be $200,000. So that's obviously not a very high purchase price to get a true 1% down when added to this 2% grant. The other issue related to this product is that to be eligible, your income has to be 80% of the area median income. So that's a relatively low threshold that you have to stay under in order to be eligible for the program. However, what was interesting about Rocket's announcement is it was actually a better terms for this program than what UWM had offered earlier. Why? Because when UWM offered this, their initial program was, again, the same 1% down, added to a 2% grant, but eligibility for their program initially was 50% of adjusted median income to be eligible. But of course, in response to what Rocket did, UWM has now raised theirs to an 80% of area median to be eligible. So now they're both at 80% area median income to be eligible for the program. But again, 1% down payment is only going to be achieved, truly be achieved, if your purchase price is only $200,000, because that's where the $4,000 max in dollars is available from either lender when they provide this 2% grant. So what does this mean in terms of the area median income? Well, I'm going to give you a couple of figures here based on some certain counties here in Southern California. For one, in Riverside, San Bernardino County, the area median income, 80% of area median income for a family of four, it's only $74,550. Now, that limit is going to work fine if you can actually find a $200,000 house where you're going to get a true 1% down when you add your 2% grant of $4,000. But the problem there, the challenge there is, in reality, a single family home in particular, not likely you're going to find something for $200,000 pretty much anywhere in these two counties. It's probably more like $400,000. Well, when you think of it that way, this $4,000 max on the 2% grant, really what that means on a $400,000 purchase price is you're putting 2% down because of this $4,000 limit. $4,000 as to $400,000 is 1%, right? So if you're putting 3% down and your 2% grant's capped at a $4,000 amount, then for a $400,000 purchase, you really have to put 2% down, and you're only getting 1% help from the grant. And of course, at $400,000, at current mortgage rates, a $74,000 maximum income limit to be eligible makes for a very small window in terms of eligibility based on debt ratio. Because at a $400,000 price, where you're financing almost all of that, 97% of that, that housing expense is going to get up there, and you're going to be pushing against the maximum debt ratio that's going to be available to even get approved for the program, even though you're eligible based on your income being below this limit. Now, the numbers get better in other counties. LA County, for example, for a family of four, the 80% of AMI is $100,900. And in Orange County, it's $114,800. So obviously those are bigger numbers to work with to be eligible. But again, consider the property values in those other counties. Certainly in Orange County, and probably in most of LA County, even a $400,000 price level is probably going to be problematic to find a decent single family home. It's probably more like $800,000. Well, again, if you're looking at an $800,000 home in Orange County, and this program only offers a 2% grant with a $4,000 cap in dollars, well, then ultimately on an $800,000 home, this grant is only worth about 0.5% of your purchase price. And therefore, you're really putting 2.5% down, not 1%. Plus the fact that even with the $114,800 loan amount or income limit, you're going to have a hard time qualifying on debt ratio. So it's an interesting program. It certainly creates lots of conversation, but again, the window of eligibility and qualifying based on these AMI limits makes it a little bit of a challenge. But certainly, I'm happy to show anybody some numbers. If you have something in mind, just reach out to me, and we can certainly talk about it and give you some numbers. But I wanted to point this out only because it made the news this week. So the next thing I wanted to talk about was just a reminder, and this gets back into equity lending, which is still a pretty active part of the mortgage industry, given the fact that home inventory is still pretty low, and first mortgage refis are certainly also not where they were a couple of years ago. So I just want to remind you again of the Home Safe Second program. If you remember, this is something I talked about a couple of weeks ago, where it's a program, it's an alternative for a senior homeowner who maybe has a low rate first mortgage. They're not interested in getting a reverse mortgage, but they got a ton of equity. They'd like to tap into that, but at the same time, they don't really want to deal with mortgage payments and so forth. So again, the Home Safe Second is a great, great option. We're getting a lot of interest in this product. Again, you have to be 62 to be eligible, and generally works best if you have a low low first mortgage rate that you don't want to touch. You're handling it comfortably, but you want to tap into that equity. So again, with the Home Safe Second, what's pretty cool about it is it's a fixed rate second. It's a closed-end second. It's not a home equity line of credit. So it's not a line of credit at all. It's a fixed rate second where when you get the loan, you're going to get the proceeds all in one lump sum. But the attractive part of the program is you have no monthly payments. And if you miss a payment, which of course you're not going to because you're not making any payments, but if you're missing a payment, say on your first mortgage, it's not going to affect your credit at all. So, well, actually it would on your first mortgage, but because you're not making monthly payments on this, you don't have to worry about your credit being affected by this type of program. And remember, it's a non-recourse loan. So at a later date, when the homeowner passes on and their family presumably takes over the property, if the property value has fallen after this home safe second has been taken out to the point where maybe the combination of the first mortgage and the home safe second balance exceeds the property value, the heirs that take over that property are not going to be responsible for a deficiency balance. So again, this is a great opportunity for the senior homeowner who doesn't want a reverse mortgage, but what they do want to tap into their equity for almost any reason. I remind you, keep this in mind, and make sure you check with me if you'd like to get some numbers on it. It's a great program, and I think it's proven to be a very good option for senior homeowners who don't really want a traditional HELOC or a traditional fixed rate second mortgage. So with that, the other thing I want to talk about, and I've been dealing with this a little bit lately because I've got a handful of buyers that I pre-qualified, and they're out looking for homes and submitting offers. But even though there's this belief that we've kind of gotten over the multiple offer situation and going over asking price in terms of home purchases, there's still some of that going on. Now, it depends on what market you're in. For example, I've got someone I'm working with who's trying to find a condo in South Orange County, and she's having a heck of a time getting an offer accepted because, even a condo in the 650,000 range, well, in South Orange County, that's pretty much a first-time home buyer type of a home. And because inventory is so limited, this type of buyer is having a hard time getting an offer accepted because there are still multiple offers and in some cases going over list. So what do you do? What's the advice to a home buyer who's trying to get in the game, find a home that they want to make an offer on, and be able to actually prevail? Well, I think we're in current conditions that would call for something that has been around for a long time, but I think it has a particularly good application right now in the current environment. What that involves is getting a full underwriting credit approval, even though you don't have a property address. We used to call this, sometimes we still call it a TBD underwriting, to be determined, which means, of course, the property is to be determined. But in the meantime, what we can do is we can get your application. We can document your application with all the typical things that are needed, pay stubs, W-2s, tax returns in some cases, bank statements, and so forth. Now, what we do is we would actually register this loan with a lender. Disclosures will go out to the borrower, and then the loan will be submitted for full underwriting approval. So it won't be a pre-qual and it won't be a pre-approval, which, by the way, on those terms, real quick, because I know there's still, even today, a lot of difference of opinion as to what's the difference between a pre-qual, a pre-approval, and a full approval. Well, in the simplest of terms, I would say a pre-qual is simply a case of you have somebody who's a loan originator who looks at the borrower's information, their income, their credit report, their liabilities, and they make a determination that they think the borrower will qualify. Now, they haven't done anything further. It's just simply an opinion of the originator that this borrower is pre-qualified for the loan. So, of course, what does that mean? If it's just an opinion of a mortgage originator, then the validity of that pre-qual is all about the knowledge and experience of that originator. And, you're hoping that they've done their work and calculated the numbers correctly, and therefore that they're correct in their pre-qual opinion. Now, a pre-approval is sort of a next step. And what that involves, and not just an opinion of the mortgage originator, but they go a step further, and we do this all the time, where we submit the borrower's data into an automated underwriting system. Fannie Mae's is called Desktop Underwriter, or DU. Freddie Mac's is called Loan Prospector, or LPA. So a pre-approval usually will involve, we fully package the application, but then we submit the data into one of these underwriting engines like DU to get an approved eligible recommendation. So that's sort of the next level that gets you to pre-approval. But a full underwritten approval is right to the full extent of getting the approval. You have a lender, an underwriting person who's going to review the DU findings, but then they're also going to review all the documentation and issue a written approval. It will be conditional. It'll have conditions on it, but it'll be that way. A lender's looked at it, an underwriter's looked at it, and you've got an approval that you can bank on, of course, assuming you can meet the conditions on the approval. So what does this do for the buyer? What are the benefits to the buyer? Well, one of the most important things is it gives you the power to negotiate when you're trying to find a home to get an offer accepted on, because you can negotiate with the assurance of a faster closing. You've already gone through a good part of the process all the way through underwriting. The only thing missing is presumably is the appraisal on the property that's chosen. So this gives you the power, more leverage, if you will, to negotiate, because you can assure a faster closing. You can offer less than a 30-day escrow period, for example. The other thing this helps to do is it can help us tackle any unforeseen underwriting issues. Sometimes after we take an application, we get the borrower's documentation. Sometimes that may reveal some other information we didn't know initially that may be an issue in terms of getting underwriting approval. This way, we can tackle that early on, even before the borrower's made a decision to submit on a particular property, so that way we can tackle that issue, get it resolved, to further assure the borrower that they really do have an approval that they can rely on. The next thing it does is it provides the seller with a firm approval and a fully qualified offer. In this regard, you're giving the seller the best indication possible that you have a firm written approval, a conditional approval, yes, but a firm written conditional approval, and that you're fully qualified by a lender. And presumably, if the conditions are minimal, which they should be if it's packaged properly, and we're pretty good at that, that's going to help you as you compete with other buyers, because the seller will evaluate your offer, I think, in a more positive way, because they can see that you've gone the full course of getting a lender to underwrite and fully approve your loan. So that makes a big difference in negotiations. And so what kind of programs is this available on? Pretty much all the conforming programs. We can offer this on FHA, VA, USDA, and conventional, even conventional high balance, which of course is available in San Diego County, LA, Orange County, and other counties throughout the state. So all these programs are ones that we can go ahead, get your application, fully process the application, get all your documentation, register your file, get it fully approved by an underwriter, so that you have the ability to take advantage of these other benefits and be better armed to negotiate to the point of getting an accepted offer. So I highly encourage anybody who's in the market looking to buy, consider taking this extra step. This way you get a lot of the work out of the way. You have that full approval. It's going to really help you negotiate a better outcome in terms of getting an offer accepted. So I can't emphasize that enough. Keep it in mind. We would be happy to help you with this process and get you in a good position to get your offer approved. Okay, so with that, I want to move on to actually what we had done last week. I had a closing question, and of course, the question was related to the fact last weekend, as you all know, is Memorial Day weekend, where we honor our veterans who gave the ultimate sacrifice to defend our country and our freedoms. And the question was, what is the maximum debt ratio a veteran borrower who has applied for a VA loan amount or VA loan must meet to ensure loan approval? Interesting question. And in kind of framing this question, I'll first point out that other programs such as FHA or conventional conforming, the standard debt ratio, the standard total debt ratio is 43%. But there is some wiggle room on that. With FHA, even though 43% is the standard, and again, 43% is the total debt ratio. That incorporates both your housing expense that's being projected for the new purchase, along with your recurring monthly liabilities. 43% is the total debt ratio standard. But with FHA, we can oftentimes go higher, and sometimes much higher, up to 50, even over 50, 55. I've gotten loans approved like right under 57%. With conforming conventional, Again, 43 is a standard, but we can go as high as right up to about 50% in some circumstances. So with that as a backdrop, what is the VA maximum debt ratio? Well, first of all, as it relates to VA, it's the Department of Veteran Affairs is the technical name of the agency, but the Department of Veteran Affairs does not have a maximum debt ratio requirement at all. The agency does not set a maximum debt ratio. So what does this mean? Well, what it means is, believe it or not, there are instances where we can get a VA loan approved, particularly on a purchase, where the debt ratio can be quite high, quite often high 50s. I've actually, not too long ago, a few months ago, I closed a VA purchase transaction where the total debt ratio was almost 67%. Well, why would that have been approved? Well, is it because they're a veteran borrower, just because they're a veteran? Well, not really. The reason that can happen sometimes is because VA has an extra component that's used to qualify borrowers, and that is residual income. It's a very important factor in getting VA borrowers approved. It can help get them approved even when their total debt ratio looks like it might be considerably higher than it should be. What's involved in the residual income? Well, of course, not just the proposed housing expense for the loan amount they want to purchase the home, but other things that are going to be taken into account is installment and revolving debt, childcare expenses, and utilities. So all that's going to be subtracted or deducted from the borrower's gross monthly income. And then the resulting amount, the resulting figure, is considered residual income. And then what the Department of Veteran Affairs has done is they publish the residual income minimums based on family size in different parts of the country. Well, in the Western United States, or the West region, the Department of Veteran Affairs has established that residual income of $1,117 is needed for a family of four. So the point here is that after we calculate the debt ratio, and let's say it's very high, maybe 65%, but then the secondary calculation is we're going to take proposed housing expense, installment revolving debt, childcare expenses, utilities. We're going to subtract all that from the borrower's gross income. And if they have a family of four, wife, 2 kids, or husband, 2 kids, then what you're going to see there is if the residual income result is at least $1,117 for that family of four, that loan is likely going to still get approved despite the high debt ratio. So the bottom line here, the point to be understood here and grasped is if your debt ratio you think may be a little higher, you've been told is a little bit high by a mortgage originator, don't be too concerned. We'll look at that residual income, and if you meet this minimum, then chances are you're still going to get that loan approval, even though you're concerned that your debt ratio might be a little bit too high. So keep that in mind. It can be very helpful for getting VA borrowers qualified, and it really has made a difference on a lot of the transactions I've done over the years. So with that, since that was last week's closing question, I wanted to go ahead and jump right into what's this week's closing question. And since we've been talking a little bit about debt ratios, I wanted to talk, the question I have for you this week is a little bit interesting. And of course, in particular, given not too long ago, we were talking about LLPAs, loan level price adjustments based on credit score. And so that's related to my question this week. And that question is, what is the minimum credit score required by Fannie Mae and Freddie Mac to be eligible for a conforming loan to refinance or purchase a primary home? So again, what is the minimum credit score required by Fannie and Freddie to be eligible for a conforming loan to refinance or purchase a primary home? If you remember that, LLPA grid we showed you a few weeks ago, you might try to remember what was the low end of that grid in terms of credit score levels. That might give you a little bit of a clue what that minimum is. But I'll give that question to you. You've got a week to kind of think it over, mull that over, and then next week we'll give you the answer, and it'll be on the house. So with that, Jeff, we'll go back to you and see if we have any questions from today's episode.
Well, that was another great episode and a lot of learning information there. That whole thing about the question it came in and said, why would you offer a program that virtually no one can qualify for. And I think they're talking about the 1% down program. That's like saying, okay, we're going to have a ride at Disneyland, but you have to be 9 feet tall. You have to, your head has to hit that, and so nobody can ride it.
Well, that's true, but I think if you think about it, what's going on there is you have to kind of remind yourself that that particular program, and this is true with pretty much almost all the mortgage programs you hear about from time to time. I mean, these are programs that are available nationally, right? So you have to take into account regional differences in median prices and home values. So yeah, certainly in our particular market in California, in Southern California for sure, and frankly, probably in most parts of California, unless you get into more rural areas, this particular 1% down program, while it creates a lot of interest, it'll make the phone ring. For our particular area, for most of our state, in fact, and certainly again, Southern California, it has pretty limited, applicability simply because the pure numbers just don't help very much given our median prices here. Our home values here are much higher than many parts of the country. So, if you get into the Midwest, maybe parts of the Southeast, there are some pretty decent homes you can get for $200,000. But are you going to get that in Palm Springs or in Orange County or in Los Angeles or San Diego? No, probably not. So that's why, on the one hand, I wanted to talk about this because it does generate interest. We do get calls about, hey, I want to use this 1% program, but part of what we try to do is educate the borrower, the prospective borrower, about the details of how it works. And so once we do that, and I've done this a couple of times, it's a little bit, there's a little bit of a deflated, reaction from the borrower because then they find out, the actual dollars involved are not that significant. So it's important to talk about, but it's going to have applicability that's going to be definitely different depending on where in the country we're talking about.
It seems like the restriction comes in with the they'll give 2% credit or 2% help there, but with a maximum of $4,000. That kind of just like throws water on the party. It seems like
it does. It really does. Like I said, in fact, in that regard, when UWM first announced their program, which was a couple of months ago, I didn't make a point once I read the details. And of course, remember at that time, their eligibility threshold was you had to be at 50% of AMI, 50% of area median income. Well, for our market and pretty much for the whole state of California, that's almost a non-starter because that income threshold, that maximum income amount at only 50% of AMI, simply too low for almost any decent property in our markets, pretty much anywhere in the state, to make the numbers work and make it a beneficial program to actually use. And I think, so at least in that regard, the competition between these two, giant wholesale companies, with Rocket coming out saying, we'll do the same thing, but at 80%, UWM, of course, quickly followed suit and said they'll go to 80%. Of course, they didn't say it was because of Rocket. They claimed they were already planning on doing that anyway. But I suspect not. It was all completely competition, raised their AMI. We better do the same just to be relevant. So they've done that. But still, even at 80%, for most of our markets in California, it's going to have pretty limited availability. So, or applicable.
One other point that was brought up about the pre-qual and the fully qualified program. That really is something that people probably should take aware of or probably be more aware of and take advantage of, because as you pointed out, and I think you said it several episodes ago, that, right now, even though the interest rates are not what they were at 3%, 4%, the availability of home is still pretty low. The inventory is still pretty low. So it's not uncommon to get multiple offers. And quite frankly, if I'm a seller and you come in with an offer all cash, or you're already fully qualified and somebody else comes in, even if they offer me full price, but they have a loan, they only have a pre-qual loan, I'm probably not going to look heavily on you, because it's like, what's that saying? One in the hand is worth two in the bush. You're probably going to lose the opportunity. So what's the process of that? Is it a lot longer process, or is it just more in depth?
No, it's the same process. I mean, and what I mean by that is if you get an offer accepted, even if you've been pre-qualified, you may have provided some documentation to the mortgage originator, maybe not all of it, but enough that the pre-approval can be determined. But then once you get your offer accepted, you go fully into loan processing. If there's any additional documentation needed, we get that in the file and try to get it submitted to the lender right away. So the real point here is to move that up in the process so that not only do you apply with an originator to get pre-approved, but you go that extra step to provide everything needed to document your loan application and then allow the mortgage originator to register that file, get disclosures out, and get it into the underwriting queue and fully underwritten. So the real point of it is you're simply moving that part of the process up to the very beginning and kind of getting it out of the way so that when you're now out there making offers, you're going to be able to include with your offer not just say a pre-approval letter from a mortgage originator and not just the DU findings, but the additional exhibit of a copy of the fully written underwriting approval that lists all the conditions so everyone knows, full transparency. That's going to give your offer a better stance compared to other offers when the seller's looking at them, and they'll help you compete with a cash offer. See, that's where a lot of times somebody who's been pre-qualified where it is just a pre-qual or even just a pre-approval, but not fully underwritten and approved, that kind of borrower is going to be at a pretty distinct disadvantage if they're competing with cash offers. If you at least have a fully underwritten approval for the offer terms you're submitting to the seller, you're going to have a better chance to compete with that cash offer, particularly if your offer price might be a little bit better than that cash offer, because as a lot of us know, cash offers tend to think, well, just because I'm offering cash, I should get a better deal on the price. I've never quite understood that mentality, but that's still out there. So to that extent, if you're fully underwritten and approved when you're submitting your offer against that cash offer, you might have a pretty good chance of getting your offer accepted if it provides better bottom line results in terms of proceeds to that seller.
Well, the other part that maybe is worth tossing in there is also you as the buyer, knowing you're going in there, you can actually say, hey, this is something I can close on in 2 weeks because I've got all my ducks in a row. And so
Exactly
you
right.
have an opportunity to move faster. Yes.
Exactly right. That's the whole point of it, is because, see, we can get that underwritten approval again before the property's even been selected. And if there are any conditions on that approval, we can go ahead and get those gathered up and into underwriting and get them cleared so that we're literally at a point where we have a fully underwritten and approved loan with no remaining conditions other than get the appraisal. And in the current market, with inventory down and number of transactions down, appraisals aren't taking very long anymore like they were, a year or two ago. I mean, we're getting appraisals in 5, 7, 10 days max. And that's why this approach, getting pre-approved, fully conditional underwritten approval in advance, can get you to a point where even though you're getting a loan, you can literally submit an offer with a 15 or 20-day escrow period. And that helps you compete with those cash offers. Again, particularly if your offer price is a little bit better than that cash offer.
Well, if you're just joining us, you want to go back and listen to the beginning of this because I described Art as the MacGyver of home loans because, there's nothing he can't do. If you're not familiar with MacGyver, go look him up on YouTube, watch a couple episodes. The guy can get anything done. He can actually fly a helicopter with a safety pin or a bobby pin. It doesn't matter. That's the way Art works. He can get it done and do it within the letter of the law. For those of you who said, hey, okay, what's my next step? I'm thinking about buying a house. I'm ready to buy a house. I want to get this fully underwritten approval taken care of. On the screen, you see Art's information. It's Art Alvarez with Mortgage Works, 760-883-5700. That's the office. Or if you want to call him on his direct line, he sleeps with that phone and he will answer it whenever you call. 714-612-9035. Just make sure if it's a little groggy, let him wake up, then go into the details. But make sure to visit him on the website, mwloan.com, or just email Art at art@mwloan.com. We're here every Thursday Art is talking about, hey, what's going on? This is the format of the show, kind of tells us what's happening with checking the pulse and what's going on out there as far as strategies that you might want to implement. Art, before I let you go, can I ask you a favor?
Sure.
Look into your crystal ball and tell us, hey, what's going to happen in the next 7 days with this whole debt ceiling, and how will that affect mortgage rates moving forward? Is it going to make it better, make it worse? What's going on here?
Well, of course, we already know now that I'm a great forecaster of the direction of rates after my prediction last week and then what happened this week. In fact, for everyone, just so you know, if you want to go to Amazon, you can buy a copy of my book about how to predict mortgage rates in the future. And of course, I'm kidding because I'm not always right. But luckily this week, at least for now, it looks like I had a pretty good forecast there. What's going to happen next week? I think the Senate's going to, it's going to pass the Senate so that this will be fully in place so that the potential catastrophe is abated. And I think with that, I think the more economic news is going to kind of come back up to the forefront. There's still a lot of signals about recessionary environment coming. So I'm gonna be bold enough to suggest that the trend downward in mortgage and bond yields and therefore mortgage rates, I think it's going to continue, especially if we do get the Senate vote and it's fully passed, so that the debt ceiling negotiations are fully behind us. And with that occurring, and if I'm right about that, then I think we're going to see some more improvement. Because remember, not that long ago, the 10-year yield was under 340. And I think we're going to be heading back in that direction relatively soon. So fingers are crossed that my prediction's going to come true. We'll see next week.
That's really good. That's really good news. And hey, again, if you're watching this live or you're watching it recorded, what does that mean for you? That means right now, whether the rates go up or down, you're already in a very tight inventory market. So get with Art as soon as possible. Call him on his cell phone, wake him up at night, middle of the day. It doesn't matter. Get your fully underwritten approval taken care of so you can take action and close in 2 weeks, 15 days, whatever you need to do, and be in a position just as if you're walking in with cash and make a decision. So take advantage of the rates, take advantage of the conditions in the market, and do that with Art Alvarez of Mortgage Work. Art, thank you so much for being here. Make sure to join us every Thursday from 2 to 2:30. We really appreciate it. Any last parting thoughts before we let you go?
No, I think that's it. Thank you very much, Jeff. Thank you, everyone for watching. Stay tuned for next week. And remember, we've got the answers and they're on the house.